Okay, good afternoon, everyone. Thanks for Amit and Doug for having our paper in this conference. A pleasure to be here. And yes, this is co-author with Matt Passer, who used to be a student here and whose father is here, I just learned. So be nice, please. And of course, he's responsible for the mistake. So. Now, given the subject of this, I should make it clear in this case that these are our views and not necessarily those of the Fed of New York or the Federal Reserve System. And you'll see probably that soon why. So what is this about? So I'm sure many of you are familiar with some of these debates, and if not, you'll get to see them soon. So we had Basel II, who was introduced in '87, where basically the assets of the bank were bucketed in different groups, and each group had a risk weight which was fixed. It was a very simplistic world, okay? And those risk weighted would be used basically to compute the risk-weighted asset capitals, which would then determine how much capital the banks would have to have. Now, soon after its implementation, or probably even before, Basel I started being heavily criticized because the risk weights were too sparse or they were not picking up risk correctly. There were all criticisms from all different places. And then that together with developments in finance, and of course, because of a big push also with banks, we moved away or start moving away from that model into Basel II, where one of the key changes was basically to allow banks to use their own models to determine the risk weights. So it was a completely different setting. And instead of using that fixed, so what the banks would do is that they will use their models to determine for each security, you can think this way, can be a loan or so forth, what is the probability of default, what is the loss given default, what's the exposure at default. You multiply those three things, and it gives you the risk-weighted asset component, and that will tell you how much capital you need to have. No? So we went from a world of prescribed everything fixed to one where we were giving basically the banks this opportunity to determine the risk weights. And of course, there was lots of praise, some of them correctly pointed out because, well, this is more flexible, captures risk in a better way, makes use of the information that the banks have, and banks have more information than any other outsiders and so forth. Except in all of that, one of the things that apparently was missed in all these designs is one key insight that came, in fact, I learned this while going through this, that Goodhart had already made this, and then Lucas, the famous Lucas critique, which is, well, once you change the use of something that the banks are doing, they are going to change the way they do that same thing. Of course, here is, well, if you are going to make their capital depending on the risk they say the asset has, of course, their incentives to reveal truthfully the risk of that asset are going to change. That's an obvious thing that we learn and we'd expect. And of course, in that setting, we would expect to put mechanisms in place somehow to control what the banks are doing. None of that was put in place, at least in a big chunk. But instead, the assumption appeared to be that, well, banks will use all the information they have available, and they will produce the risk matrix in an accurate way, and we'll go about business and rely on their information and we'll be happy. So why is this important? Well, of course, once you allow for some discretionary part on the banks, well, it undermines the regulatory capital ratios because they will start meaning different things, misleads the market participants, and of course going to weaken the market discipline, and of course is going to create some inequities in terms of competition. And to be fair, and this in fact was a quote that helped us quite a bit, we are not the first one to highlight some of these issues. Governor Tarullo some time ago in a speech made this comment that the combined complexity and opacity of risk weights generated by each banking organization for purpose of its regulatory capital requirement created a manifold risks of gaming, mistake, and monitoring difficulty. Okay? So that turned out to be quite helpful for us, at least to get some insurance for what we were doing. If the governor can say, we can try to prove. So what is it that the paper does? And so here's a preview of what we try to do and also the results. So what we are going to try is to investigate the risk estimates that banks report for supervisory purpose within credit syndicates. And I'll come back to this because this is very important for the purpose of identification. And here are some of the results that we find. One is that, well, there are systematic differences across banks. And by the way, these have already, within different settings, had been documented. I think the key difference in what we do is in a better way in terms of identification. But then we go a step further, which is, well, it's not only there are differences, but banks with less capital are the ones who are reporting lower risk metrics. Okay? And the magnitudes are large. This is not just a statistical significance issue, and it can bias the risk-weighted assets up to 20%, so it's an important difference. And then we show that the relations are stronger for the credits that we would expect if there were some regulatory motive for larger, riskier, and more opaque credits. One other thing we do to complement is that we are going to look at the pricing when the banks price these loans to see if they view risk the same way as compared to when they are assigning the risk metrics. Are the two in sync? And what we are going to find is that they are not. Those banks that tend to report lower risk metrics, their risk metrics are less informative vis-a-vis the pricing that they set on those loans. I'll come back to this, of course. And what we argue here is the evidence is consistent with an effort by low capital banks to save on capital when they are disclosing this information. There are certainly other explanations that, of course, that's important to consider. As I said, related literature. So the paper is basically related to two camps of the literature. The first one is a series of papers that looked at these inconsistencies of risk metrics. There are 2 or 3 initial studies that look at this, but mostly in a cross-section. Okay? And at the time, these were within syndicates. So think of this, the unit observation is a loan that it's owned by multiple banks, and each bank is reporting the risk metric on that for that same loan. And at that time, they were already documenting that there were differences in the risk metrics that the banks were reporting. Now, vis-a-vis these studies, the key difference that we have here, one is that we have a panel. It's not just a cross-section. The second thing is that we can look, because one of the things that you wore in this exercise is, are all banks updating their information at the same point in time, or some of them update more frequently than others? So we can condition on origination date, which is, look, here are a bunch of banks that are looking at the same credit on the same date. Do you still see the discrepancy? So it's pushing the identification one step further. The other key difference is that we are more interested in understanding what's driving this difference, not just documenting there are differences. It's probably not surprising, but what is the source? There are 2 other papers that are probably even closer to ours that are along these lines. One look at this in the value at risk for market pricing, and one of the things that they find is that the value at risk violations in trading books are correlated with bank capital, so it has a little bit of the same flavor. This other paper, which I believe it's in the program tomorrow, uses German data, and what they document is that when the banks transition from the standard approach to this advanced approach, meaning from the Basel I to Basel II in essence, the PDs for loans originated under the internal models tend to be lower when compared to several loans originated under the standardized approach, basically the banks pushing the risk metrics down. Now, vis-a-vis this, well, the former relies in comparison across different portfolios or different banks. So, and the later emphasizes is within bank difference. So we have a much tighter setting where we can look is within a given loan. So it makes it a comparison better. The other one is that both papers, particularly the first one, not as much as the second, focus on exposed measures of risk. We focus on ex-ante, which, of course, for the purpose of regulatory, that's what it matters. And also exposed, yeah, in good times, how many loans default. So all banks look good in that setting. The second set of literature, there is a couple of papers, some written by people I think are here, that documented how incentives played in distorting the risk estimates in the mortgage securitization process. You can view our paper as the same, but in the corporate lending space. So what's the data? Well, our main data source is this program. It's a supervisory database. It's called the Shared National Program. And what this problem collects is, or at least has been for 2 decades, annual data on loans of 20 million or more. These are syndicated loans that are owned by 2 or more supervised institutions. So it grabs pretty much the large market, the corporate market. And the agents in the data report very detailed information about what's the loan, when it's originated, how much each investor owns of the loan, and report that with an annual frequency. Okay, that was the original. Now, beginning in 2009, the banks who adopted the advanced internal approach were required to start reporting this data quarterly. And that's the group that's called the expanded reporters. And in addition to that, they were required to report the risk metrics for the purpose of capital, meaning what's the probability, the exposure, and the loss given default for each credit. And that's what is used to compute the risk-weighted assets, and that's what we are going to use. So just to be clear, so what we have is each unit of observation is one loan, and we have a bunch of banks, the ones that fit into this category, that are reporting the risk metrics for that same loan. Okay? And the conditions are such that, or the instructions is that the PD is supposed to be borrower specific, so you report the PD for the borrower. The exposure at default is how much is your exposure, and the loss given default is how much you expect to recover. Okay? And also in the loss given default, they are supposed to report in 2 ways. One is before credit enhancements, and one after credit enhancements, meaning, well, if I buy protection, of course, the loss given default will be different, or if I have secure, or if the loan is collateralized. Also, to understand the setting, Basel II adoption is mandatory for all the large international active banks and optional for others. And the way it works is that banks, before they start using Basel II, they go through what's called a parallel run period, where they have to report the capital both ways. And eventually, the regulators will approve and say, fine, you get out of the parallel and you start using only the internal approach. In our sample, we have both types of banks, and I'll come back to this because one of the concerns that people had at the beginning was like, well, maybe you're getting the results because they are trying to window dressing to convince the regulators that they are doing it well, and then eventually things will change. That's not quite what goes on, but it's a valid concern. Oops, too fast. So what are the sample? So the sample is we have about 15,000 credits that come from about 7,500 borrowers over 14 quarters from 2010 Q2 to 2013 Q3. There were a couple of quarters before that they were already reporting, but the data was not very good, so we threw them out to be sure. So we have 15 banks in the sample, so it's not a large sample, so that's, but it's what we can use. 9 banks are in the sample from the very beginning, others enter throughout the period, and the last one entered in the first quarter of 2013. But to give you an idea, of course, these are big banks, and on average they have about 1,000 credits, and the median is 561. So I have lots of observations for each of the banks. Sure.
So how big is the syndicate typically?
Well, it can vary a lot. You can have a syndicate with 10, 20, 30 institutions. Not all of them are banks. Some are non-banks. And we don't observe all of them. Yes, in the ideal world, we would like to have the entire syndicate. There are syndicates for which we have 6, 7 banks, and other ones for which we have 2 or 3.
But of the 15 banks, are there times where there's 5 or 6 banks of your sample?
Yes, in fact, one of the conditions here, it's already, these numbers are conditioned cases where at least we have 2 banks. Because otherwise, yes. Right. Well, there are loans in the data for which there is only one reporting. We cannot use them. Because one of the things, as you will see, the exercise we do is that when I'm saying that they report lower PDs or lower risk metrics is vis-a-vis the median of the banks reporting in the syndicate. Is not an absolute term sense, okay? So that's a requirement that we already factor in here. I should have made that clear. So all the exercise is done vis-a-vis either the mean, we do the mean, or the median reporting information in the syndicate. That's what we mean, low or high vis-a-vis. It's not any other We could use other metrics and compare for that, but we don't want to do that. So the first thing we do is, well, we compute this difference. It goes back to the point, so why we need at least two. We compute these differences for the metrics that the banks report. So for each loan, so this is the probability of default that the bank reports for the loan. How does that difference compares to the median of the probability reported by the remaining banks in the syndicate, okay, within the same loan? So we have this difference, and then we are going to start with is to run this on banks fixed effect, time fixed effect, to see if there are any systematic difference or not. So that's the basic thing, right? And the null hypothesis is that if everyone was reporting the same thing, of course, this difference would be 0. So it's not a pretty table, but it tells the story here. So you have all the banks. Of course, we cannot put the names because the data is confidential. You can take some wild guesses. So the first, so the first one is the probability of default. This is the loss given default. This is the product. This is loss given default before credit enhancements. This is the one after, and this is the risk-weighted assets in percentage. Don't worry too much about this. Here is the F-test, whether they are all equal and equal to 0. And as you can see by the size of the numbers, you can reject that they are not. Which basically it's saying, in a very simple way, is that there are systematic differences among the risk metrics that these banks are reporting for the same borrower at the same point in time. Okay? Then we go one step further. Let's add some, just to see how robust this was for this purpose. Let's add some controls to this and see, well, do the results go away? Because you could say, well, maybe it's because they have a bigger exposure and they report differently, or it's a bigger bank and they act differently somehow. No, pretty much it stays there. So it doesn't go away, so it's robust. And I would say to some extent, this is just a confirmation that some evidence and some suspicion that was already from prior studies, and so this is just adding more to that. The question is, why? What's behind this, right? Is there just some, and I'll come back to many, you can tell different stories about this. But one, of course, being interested in regulation, one that comes already to your mind, that could it be that banks with less capital are the ones who are trying to save on capital by reporting lower risk metrics? So that's one potential. And that's the one we are going to focus, and I'll come back because, of course, the identification is a key issue here. And so what we do is we run two models, and they are the same version. So on the left-hand side, we had that difference. Again, when I say lower, high, slow vis-a-vis the median, so that's what we are using here. So how does that vary with the tier 1 ratio of the reporting bank? You're going to add a bunch of controls. We are going to distinguish whether the bank is the agent or one of the participants, time fixed effects. Of course, tier 1 is endogenous, and so we are going to create another variable which we call tier 1 gap, which is basically, you can think of it, what would be the capital that the bank would have given its fundamentals, and then you compute for the residuals from that and see if the results differ. Okay? So here are the results. And from this point on, I'm going to focus, because I think it's the cleanest, I'm going to focus on the PDs. Because in the loss given default, you could argue that, well, is it that surprising that the loss given default between two banks vis-a-vis the same borrower differs? Maybe not, because some banks may specialize and have more experience in recovering when a loan defaults than others. So that could be a reason why one bank systematically reports higher loss given defaults vis-a-vis the other. So for that reason, we have the results for the loss given default, but we focus for the most part on the probability of default because it clearly says it's supposed to be the probability of default of the borrower, and so it's not idiosyncratic to the bank. So the point here is, to make the story short is, well, here it is. Banks that have lower capital, lower tier 1, tend to report lower PDs vis-a-vis the median of the syndicate. That's what it is. Once you control it, of course, and that's more to get to the point for the importance. Once you multiply by the loss given default before or after and the risk-weighted assets, it still matters and it will influence your capital. And it stays if we use that other alternative measure of the tier 1 gap. So it's not just specific to the tier 1, so it's robust. And by the way, I should focus on this, and because I'm going to come back, this is at the credit level analysis. Okay? So, and then we go one step further. This is interesting, but I'll go quick. Here is to see, well, are there differences across different types of credits that would point in some particular direction? That's the point I made earlier. And so we extend the model to interact to different types. And one of the things we find is that the impact is larger for riskier credits than safer ones. So for safer credits, you don't find that impact. Drawn versus undrawn, this is basically because some are credit lines. If it's not drawn, it has a lower impact on capital than if it's drawn down. Large credits or large exposures, and private firms versus public firms. Of course, the point here is, well, and someone could say here, that's interesting, it's robust, but that's the credit level. Does that mean it still has an impact at the portfolio? Because for the purpose of capital, what you care is not at the individual credit level. You want to make sure that it's at the portfolio level. In other words, for the entirety of the portfolio of the bank. Of course, we don't have the entirety, but we can aggregate all of these credits to get what we have at the bank level. And so what we do is that we are going to compute those differences, and we are going to compute a weighted difference by how much the bank owns of the credit. So we weight that, and we have a measure of the portfolio of the bank. And so we run that. Well, I'll show you the regression, but here it is. So on the left-hand side now, this is at the bank level. So it's those deviations, the PD vis-a-vis the median of the syndicate, weighted by how much the credit of the bank owns. So it gives you a measure of the entire deviation at the bank level. Now, if there were no differences, you would expect that line to be flat. But what we have instead, it's increasing, meaning basically that banks with lower capital are pushing down their PDs, and as a result, their risk-weighted assets are coming down. And yes, and here is the results, and here's the significance again in the two ways, and it persists throughout. So it's a pretty robust, holds at the credit level, and it holds at the portfolio level, which is then suggesting, yes, the amount of capital that these banks can save by pushing systematically down, it's going to be affected by this practice. Of course, at this stage, the question is, well, identification, right? Is this really a regulatory capital motive, or is it something else different, right? I'm going to, at least hopefully, try to dismiss some of the stories. I'm sure you'll come up with more, and I'll be happy to hear them. And I'm sure some of you will never be or will not be convinced. That's fair enough. But at least I think one has to be careful in at least thinking, okay, does it make sense? So let's go through this. First, reverse causality. I've been telling the story that, well, it's the banks with less capital that are trying to save on capital and are pushing down this. Could it go the other way around? Well, no, because if it were the other way around, the result would be reversed. Because in that case, lower PDs would lower the risk-weighted assets and would increase the Tier 1 ratio. And we find exactly the opposite. So that one is easy. Next story. Well, could it be a learning story? So banks suffer a loss and they adjust their portfolio. So it becomes risky. So the PDs go up, risk-weighted assets go up, so the Tier 1 goes down. Again, it's the opposite. So that cannot be. Another one that at some point someone told us, well, maybe these guys are just they are not good. And that is correlated with capital. Basically, low PDs and Tier 1 are just signs of poor skill, right? But if that were the case, what you expect is more noisier measures. Being incompetent should not explain you systematically pushing down the numbers. So it doesn't seem to be the case. The next one is harder to dismiss. One story that you can tell is this has nothing to do with any attempt to save on capital. It's just a difference in risk attitude. You can think of banks that operate with low capital are more risk tolerant. And because they are more risk tolerant, when they look at the risk of their borrowers, they also assign lower PDs. That's a feasible story, would match the pattern that we find. Doesn't seem to be the case because for two things. One thing is, if we run, let me move forward here. If we add bank fixed effects to the model, the results stay. That's the first one here. So we have all the controls, and we add bank fixed effects. So anything, and this is important because it's telling anything that is a treat that is bank specific, it's not what's driving the result. One other thing we do is to say, look, if that were the story, let's compute a measure of the riskiness of the bank portfolio. And the way we compute that, we say, let's pick the median on each credit of PD. We weight that by how much the bank owns of that credit. That gives us a sign of the riskiness of the bank portfolio. And the bank is conservative, so it's taking lots of risks, so it should be reporting lower PDs. Well, it goes exactly the opposite direction. But perhaps more importantly, even when we control for that, the result doesn't go away. So it doesn't seem to be the risk attitude story. Next one. It's even harder to dismiss. And this one, I think there is some evidence, to be fair, that seems to be here. One story is that you can tell that would explain these results. It's about, we call it selectivity or being picky. You can think of this way. The bank looks at each loans out there and says, well, I'm going to choose to participate only in those loans for which I think my model tells me that the PD is lower than the PD or the other, so I can make more money because everyone is getting the same interest rate on these loans. So, but if my model is telling that the loan is less risky than everyone else, so it's a good deal for me, I'm going to participate in that. Selectivity story. Now, we do two tests for this, and I would say, to be fair, is that there is some evidence for it. I don't think it's the entirety of the story. Tell you why. One of the tests that we do is, so as for those who are not very familiar with this, probably I should have explained this at the beginning. In the syndicated loan market, the way it operates is that there is an arranger, sometimes it's called the lead bank. That's the one that basically negotiates the deal and interacts with the borrower. And then there is a bunch of participants. Okay? Now, if you think about selection story that I mentioned, it's more likely to be the case for a participant. It's easier for me to say yes or no that I'm going to participate in a deal. For the lead banks, which it tends to be a smaller group that are able to do that, it's much harder for them to walk away and say, oh, no, I don't want to participate in this, because that's part of their business. So one thing we did was redo the analysis, just restricting to lead arrangers, and the results still hold. So it doesn't seem to be quite that. The second way we did was we created a measure of participation, which is the following. In each quarter, we say, here are the loans that appear in the market in that quarter. What percentage of the loans each bank gets on that quarter or participates in that quarter? Now, if I am very picky, that percentage will tend to be smaller, right? I'm going to fish around and pick which ones fit my style. If I'm less picky, well, that percentage will be high. Basically, I'll tend to be in all of them. So let's see how that so that's the participation. And it is indeed positive. So meaning that, well, the pickier you are, you tend to report those lower PDs. So that's consistent with the selectivity story. So there is some support for that going on here. That said, even when we control, we still get the same correlation on capital. So doesn't seem to be the entirety. Before I go to a couple of more stories, just 2 or 3 things that I want to mention here. Here we separate the sample between foreign banks and domestic banks, because we have foreign and domestic, just to make sure that the results somehow were not being driven by there have been lots of complaints or that different regulators treat this differently. And the results are stronger here than here, and they don't go away. This is also important because of the issue that I mentioned earlier. Remember, I said that we have 2 sets of banks. The ones that are in the parallel run, meaning that they haven't had their models yet approved, and the ones who have the models approved. The ones who have, this one has a much higher proportion of ones that have the models approved than here, and in fact the results are stronger here. This is important because people tend to say, well, look, what's driving the results here, there is a subset of banks that are in the parallel run, they want to impress the regulators, and so they report very high PDs, and so make sure that the regulators buys in the model. So if that were the case, you would expect to be much higher here than here. We have a separate one. I don't have it here where we clearly separate the 2 groups, but you get the same story. Let's go back to more stories about identification. I have a couple more here. See if I can exhaust. Next one that someone at some point told us, well, it's true that all banks get fees, all banks get the same spread for each loan, but it is also true that the lead arranger gets some fees in compensation for the additional services that the bank provides. And that could be the explanation. It says, okay, fair enough. So, but if that's the case, it would have to be that the high capital banks receive the fees. But one of the things that we do is that the results hold when we distinguish agents and participants. So it doesn't seem to be, again, the driver. Next one, cross-selling is often a tough one. Well, what's happening here is that, yes, they get the same interest rate, but there is a subset of these banks, they are cross-selling lending with other activities, and that could explain the story. Okay? If that were, again, it would have to be the high capital banks, because these are the ones that they say, well, the risk is higher, I'm going to get a lower interest rate, but I'm being compensated because of the other business that I'm doing. But, well, the high cap, first of all, is that the results hold within banks. So if it's one bank that systematically is doing cross-selling, we should have been able to kill when we put the bank fixed effects. The other part that I think one can argue, and there isn't much we can do about this, because of course we don't know to what extent banks are cross-selling and whether they are making money on the other business or not. One point that we do know is that the largest banks are the ones that tend to do more cross-selling, not the smaller banks. And largest banks tend to have low capital compared to the smaller ones. And here the story to work it would have to be the other way around. So that's how far we can go. Next one, competition. Low capital banks, and this one we have heard a couple of times. Low capital banks compete more aggressively because they have less capital, so they can afford to do that. But the first thing is that, but the results hold when we control for participation. And I think this is an important point to be mindful is that, first of all, of course, banks compete on the interest rates. They are not going to compete on the PDs. The other thing also is that banks do not announce these PDs to borrowers. They don't go around and tell you and then tell them, well, look, this is your PD that I'm going to assign you. They say, well, this is the interest rate I'm going to charge. So it doesn't seem how that could work. The last one we have heard is this, because I guess it has been a period of being popular, the search for yields. Well, could it be that low capital banks are more interested in loans that have a higher return to capital invested? This is a bit the same story of selective, if they are being picky and choosing the right ones, but we already showed that there is some evidence for this. It doesn't seem to be the explanation. But the other thing is that, well, if these were generalized, meaning to all the loans, well, then it is basically our story, except it's calling it differently. The reason why they are more interested and they find these loans more profitable is that because they are lowering the PDs. And by lowering the PDs, they reduce the amount of capital that they need to set aside, and so the loans become more profitable. It's basically calling the same thing, but behind it is just a pushing or a regulatory arbitrage exercise. So much for storage. A couple of words on robustness. So several tests that we do. As I said, we run the results excluding any one bank at a time just to make sure that no single bank drives the results, still stays. As I said, results are robust when we keep just the parallel or the non-parallel runs, banks. When we use the mean as opposed to the median, so the difference is vis-a-vis the mean reported for the syndicate as opposed to the median. This is about the interactions. One last point that, and this was something we haven't added yet to the paper, but we just did because there is some econometric issues when you run the models with this difference vis-a-vis the median. And so one of the things we did was to run without the median, just do at the credit level, adding a fixed effect for the credit and see if the results persist. And the answer is yes. Now, results from the loan spreads. Now, here I should be careful, and I want to warn that I think this is interesting, but we are mindful because the sample is going to shrink. So we have a smaller number of banks here, so I don't want to make too much of this. But I think it's interesting because it goes in the same direction, or it has some consistency. So the exercise that we have is the following. It says, look, we know what the banks are reporting on these risk metrics. We also know for the arrangers, and because in general it's the arrangers that has more influence on the interest rate on the loan, we know what's the interest rate on these loans, okay? Or at least for the subset. It's one of the downsides of the SNC data. They don't collect information on prices, so we had to merge this with deal scan, which is a bit of a nightmare, but we merged that and we have the interest rates on these loans. And the thought exercise that we do is the following. It says, look, if there is a subset of banks here that systematically report lower risk than the others for the loans. When they price those loans, is the pricing aligned with the risk they are assigning to these loans or not? Or is there a systematic difference? And in particular, we have these two hypotheses, which is, well, if the banks that are systematically reporting the lower PDs, if the deviation is proportional, in the loan pricing model, the coefficient on the PD that the bank reports for that loan should be higher, right? Because it's basically saying, well, I recognize that this loan is riskier. I'm going to set the interest rate according to that risk, but I report a lower PD that doesn't quite fit that risk. The other one is to see for those models if the explanatory power of those banks, of their PDs, is similar to the ones that report the higher PDs. Okay? So we run this model. So we have the log. This is the spread. This is at origination date of the loan. So it's a spread over LIBOR as a function of the PD that the bank reports for that loan. And we have loan controls and time fixed effects. And again, so the sample drops because we don't have enough data for all of the banks. So we have now only 8 banks. So don't kill me because of that. Yes, I'm aware. So it's a small sample. But still, it's interesting. So here I'm just plotting. So this is the coefficient that on the probability of default of the loan. And so here is the tier 1. And what we have is that, well, for the banks with low capital, their coefficient is much higher than for the other ones, which suggestive that, well, the interest rates they recognize, it's riskier. It's the PD that they don't seem to recognize that. And this is the R squares for, again, the pricing of each of those banks on their loan models. And yes, for the banks with lower tier 1, their PDs have much lower explanatory power of the interest rates they set than on the other ones. Now, you can tell all kinds of stories about this, but it certainly goes in the direction that in the pricing, they recognize better the risk than on the PDs that they assign to the same loan. So let me conclude. So what is it that we find here? And so banks with lower capital report downward biased estimates, again, vis-a-vis the median of the syndicate. And this finding, together with the spread, suggests a regulatory arbitrage motive. Now, and I think this is important. I went through all of those other cases. I'm sure if we sit here and discuss, you'll give me more ideas, and I'm glad to add those. I'm sure some of them we will not be able to disprove, not entirely. That's virtually impossible. But I want to make a broader point, which is the following. Even if you disregard all of this, or even if you want to attribute a different motive, or a bunch of them, regardless of that, I would argue that this is quite troublesome that you have this correlation. Because basically it is telling us that, yes, everyone is facing the same regulatory, but the banks with lower capital are able, basically effectively, to operate with less capital by virtue of reporting lower risk metrics. Whatever is the motive or the mechanism, I don't think it eliminates that fact. Now, of course, if it were the other way around, it would be less concerning. If for some reason we were finding, well, it's the high capital banks that systematically report lower PDs, I'd say, well, it's still not quite nice, but at least those are the safer ones. Now, of course, this raises an issue and goes back a little bit to the point that Patrick was raising, is that, well, of course, it raises an issue about this trend of moving away from these fixed, more strict rules into more bank-dominated rules is, well, how do we control for this? Yes, we want to take advantage, but we need to control for this. And it's not easy, in part because you could say the obvious answer here would be, well, you basically put mechanisms in place that you compare these across banks, right? It's like, well, if one bank is deviating too much, it automatically picks on that. Except you get into these issues of the beauty contest that all the banks start reporting not the true, but what they expect the other one is going to report and so forth. The other difficulty is that, well, there is a huge section of the corporate lending, for example, that is not syndicated loan and for which these comparisons are not easy to do. One final aspect, and going more directly to you, is, well, you are asking why the regulators are allowing this. That was my first question, was whether there was even any mechanisms in place, and the answer is none. Now, in the market pricing, at least there are rules for the number of violations that you have and that can trigger some action. on this space, there were no controls put in place. The assumption was, and goes back to where I started, that, well, we approve these models and we believe that the banks will continue reporting all the information and truthfully all the risk metrics that the way they view it, and that's the way we'll go, and we don't need to check in any way, shape, or form. Of course, one solution to this, which to some extent we are moving, is get a bit away of this and start going back to the old leverage ratios, which become immune to this. And I'm done. Thank you.
Yeah, well, thank you for having me here to discuss this, this really interesting paper. The standard disclaimer, these aren't the views of the Cleveland Fed or the Fed system at all. Okay, all right, let me give a little background, give you a little perspective. Because one of the things I like about this paper is it gives us some evidence on some bigger picture issues that have been floating around for a while in the world of capital regulations. So Basel I, 1988, we get a fixed capital charge by asset class, all right? Everybody knows right away that there's weaknesses with that. The banks certainly started gaming things pretty quickly with off-balance sheet things. And so there was a goal that developed pretty quickly to develop a way to get the capital charges to be more risk-tailored, okay, to the assets, all right? And the strategy, one of the strategies to use was the idea to get the information from the banks, use the models like João talked about. And the idea was, well, banks know the information better than regulators. And so let's elicit that information from the banks and also use the agent. There was also this other stuff going on where they'd use agency ratings when available, but I'm not going to talk about that. But a big part of the effort was to get the banks to report their information. And actually this idea of the bank reporting risk actually shows up in a variety of regulatory regimes. So there was this proposal by Paul Kupiak and Jim O'Brien back in the mid-90s called the pre-commitment approach, and it had banks choosing their capital with some penalties if that capital got exceeded by losses. What's been in place for a while for just the trading book of these large banks is something called the internals and models approach for market risk. And again, it's banks report their risk. They use their value risk models. And if there's violations of those value risk models, that is, if losses in that trading portfolio exceed the capital, by some frequency, then bad things can happen. You can't use it anymore. And they do some back testing of that. Basel II, which João talked to, and I'll give into some more detail in a little bit, uses this. But even the stress tests, this is a big part of the stress test. So what goes on with these CCAR stress tests is the banks send a report. I mean, they run their models of how much capital that they would need to hold under some particular scenarios that the Fed gives them. And of course, while they're sending the number, maybe it's not so good. So we run our own. The Fed runs its own models as a check. And if your numbers are below the Fed's models, you don't get to pay dividends and things like that. So this idea of the incentives and reporting risk is floating around more than just the Basel II ARB thing. So the big challenge with using these bank reports, of course, is that banks have an incentive to report low risk. All right, and that's what this paper is about. They basically, João and Matt find some evidence that under this Basel II regime, at least for the wholesale credit portion of the credit charges, they find some evidence that banks underreport risk. So let me just review the Basel II, how that works in implementation. So this advanced internal ratings-based approach, it only applies to a few of the largest banks. It's only been in place since, 2009 was the first bank to get it in the US. And there's a formula. So the formula is given by the regulators. There's a probability default, a loss given default, and exposure default. And the formula is going to vary on the type of asset. So there's credit card stuff, there's wholesale. Wholesale covers these syndicated loans that their analysis is about, as well as other categories. And these three numbers, so the formula is not something the banks can play with. But where the bank's reporting comes in is they have their own internal risk rating systems. It could be a model. In the old days, maybe it was a simple scorecard, may still be. And those numbers from their risk models get mapped into probability defaults, loss given defaults, EAD numbers. And that's where there's potentially a chance of underreporting. That's where the ability is going to come in. And I'm going to get in more detail how they may be able to do this later. So here's their approach. I think it's a really clever, nice idea. They take these syndicated loans, multiple banks with same credit, compare the reports, okay? And if you do information theory, there's this old ideas about setting up games with people who have the same information, eliciting information. There's like on Harris Townsend and Ma, I think it was Ma as well in the 80s. And this is kind of along that idea. Basically, these banks have the same credit. Let's compare the reports. And the shared national credit, the system that they're exploiting, is basically these large syndicated loans get examined by one regulator, and the results are shared across the regulators. And it's not just even within the Fed. It's not like the New York Fed and I don't know, the Richmond Fed or the Cleveland Fed share this stuff. It's literally the Fed and the OCC. I'm not sure the FDIC deals with any of the banks big enough for this to be an issue, and the basic idea is let's not duplicate cost. I mean, that's one of the big motives. But the other advantage is you're going to have a consistent risk assessment when you're evaluating bank risk, at least on this portion of their portfolios. And this has been around a long time, even before Basel II. Okay, empirical strategy, look for deviations in reported probably defaults from median report for each loan, and they find some banks consistently deviate below the median. Now, I'm not going to talk that much about this today, but we all know that models are heterogeneous, okay? And so different estimates just could reflect that. I think of like different Fed's inflation forecasts. Charlie probably remembers that. Some very different ones across banks. And there's a lot of forecasting models. That's just a fact. And so the way that their evidence that this is not what's going on is that there's a pattern. And the pattern is that banks closest to the regulatory capital constraint, the low tier 1 capital banks, report a lower probability of default. And that's their key result. Okay, so that's the summary of what's going on. So what I'm going to try to do is two things. I'm going to use some theory to think about the results. I'm not going to get into the quality of the empirical analysis, and I think Philip's can get a little bit more into that, which will be good. I'm going to use some theory to think about the results, and then I'm going to talk a little bit about thinking about this whole situation as sort of a mechanism design problem, and what kind of stuff actually goes in the supervisory process. I'm going to have some different views than João about this as we go forward. So here's a real basic, simple model. Assume P is the risk of some asset that the loan has. The bank wants to minimize K, minimize capital, all right? And the regulator wants capital to be a function of the risk, and they want it concave and increasing. So you'd have something like this is just an example. And in fact, actually, the formula that they use gives you a concave function. In fact, it's much more concave than I'm showing here. It's actually, I think, much more like this, with a lot of curvature. So there's actually big gains in capital from going from this risk to this risk. The marginal impact's much bigger than from there to there. But this is the basic idea, okay? And actually, you can write down some models that'll give you this. So let's think about this reporting incentive. So you got this information, it's private information, and I'm going to go the full extreme. I'm going to give banks full leeway in the risk report, and here's the incentive constraint you'd get, okay? All right, if you're looking at a direct mechanism, it would be that the capital as a function of the state, P, has to be less than or equal to the capital that you would get if you reported any other P, all right? And that's this is the simplest hidden information problem, and it's a really restrictive constraint because the only feasible allocations is everybody gets the same capital, no matter what your P, all right? And in practice, what that level of capital will be will depend on what the rules of the game are, the payoffs. But it's going to be, from what João described, it would be very low if this was describing the environment the banks operated in. In fact, it looks like Basel I. Right? That's what Basel I does. But the data that they use shows that the capital depends on the report, and banks do not report the lowest risk, okay? So this incentive constraint's too strong to describe the environment. So let me just want to come back to what João said about no sort of checks and controls on the banks. I think there are some there, okay? Maybe they're not enough, I don't know. But they're clearly not going to the extreme with this, all right? And I think the designers of Basel II were aware of incentives. And in fact, Basel has 3 pillars. Pillar 1 is the capital stuff. Pillar 3 is market discipline. And there's this kind of Pillar 2 afterthought, which is called supervisory review. Who knows what that means, but I think you could interpret generously as making sure that the Pillar 1's being followed properly. And in the implementation, the implementation of substance practice does put some restrictions on the report. So, first of all, the formula for PD, LGD, and EAD is given, okay? And I think this comes off of the Gordy model, based on that model. And then where banks have some flexibility is on inputs to the formula. So there's going to be the choice of their own internal model, the data range, so you got to estimate these model and data ranges. And we'll get back to that in a second. As well as sometimes you have some flexibility, I think, in how loans are characterized, like what class of loans they go to. But there's even more restriction reports. And so here's where I'm going to differ with João. So I actually called up some examiners I know to try to do this kind of stuff to get a feel for just how much flexibility the banks have in their reports. And there are restrictions there, okay? So these things aren't done in a vacuum. So the risk rating model gets checked, all right? And in fact, their models have to have at least 7 bins. You can have more than 7 bins. These are like risk rating classes for the internal model. Apparently in practice, often these bins sort of correspond roughly to Moody S&P ratings. And typically in each bin, there's going to be some sort of smaller range of probability defaults associated with it. So examiners do check the defaults frequency by bins. And if things get off too much, there's this kind of amorphous world of supervisory sanctions. Some of it's implicit, some of it's, there's these things called matters requiring attention letters, and there's more serious letters, and there's a whole range of things they can do. But if they're not happy with what's going on, they can tell the banks. And apparently, some benchmarking can go across banks as well. They'll do some comparison. And furthermore, if you got publicly traded firms, you can go check the S&P, the ratings as a check on the PDs that they're giving. So, there's information out there, there's a process, there's an infrastructure, there's a lot of resources used. So it's not being done in a complete vacuum. So, based on the way they do things, it sort of suggests some additional features for, I showed you that real basic stripped down incentive model. You might want to think about things you would add to sort of capture what's going on in this process. So there's ex-ante approvals of internal risk models. There's some screening that goes on there. There could be ex-post audits of reports. Not to mention there's these repeated interactions as well as implicit and maybe some, these implicit penalties. So for example, if I was thinking about modeling the process, you could do something along this line. So put some restrictions on the reporting. Say, okay, if your true state's P, there's some set of reports you can make. Like if your risk is really low, you can't say your risk is or if your risk is really high, you can't say your risk is 0, right? It's just not going to be credible. But maybe you can say your risk is a little bit lower than it really is. So there may be some ranges. So that's one possibility. Audits, this is one I've always been interested in, and you could think of a model where, depending on the report that the bank makes, you go in and you take a deeper look at the model and see if the estimates make sense. So you get an incentive constraint that would include some probability of an audit plus a penalty if you're found to violate it. And I see elements of both approaches. Now, it's kind of a black box. I don't know exactly how important these different elements are in practice. So, but there are clearly some mechanisms in place of the banks to underreport. So what I kind of view their results as providing some evidence on the effectiveness of the implicit mechanisms in place. So, and I also kind of view the results as suggesting ways to improve the mechanism. So let me give you some possible improvements that came to mind from reading the paper. So here's the really easiest one. So they found that, the reporting, there seem to be reporting biases correlated with Tier 1 capital. Well, let's just index capital schedules by Tier 1 capital ratios, okay? You get something like this. So you'd have 2 schedules. So you'd have one formula if you had low Tier 1 capital. I guess that would be this one. And if you had high Tier 1 capital, you have another. That's the first, well, that's maybe the second obvious thing that comes out of this. I'll show you the most obvious one in a second. Another possibility, you can make ex-post reviews of models explicit and impose sanctions if a negative review. I'm going to show you some slides from an optimal, I did a little model of optimal capital with auditing frequency, where a bank had private information and regulators could audit as a function of the report. And you kind of get things like this where, if you look at the dotted line, this is how much capital they hold as a function. Think of this as P with determinist auditing. So this is like kind of a Townsend costly state verification model is really what's going on, where you audit them if their capital's down, if they report a low risk, and they get to hold less capital because you check them. But if they report higher risk, it's not worth spending the auditing resources, but they also hold a constant amount. That comes out of the incentive constraint. And if you bring in stochastic auditing, you can get more flexibility in your capital levels. And this would be the auditing frequencies, depending on your model. In this stochastic auditing, if they report, the people you want to audit are the ones who report that they have low risk, because those are the people you want to prevent the high-risk people from claiming to be low risk. So you can bring all these kind of mechanisms in place, and some of them may be there implicitly. So, and a third mechanism is just compare the reports from the median. And this was really striking to me. This is their fixed effect regression. So look at this first column. This is the probability of default. This is the results that they were emphasizing. There's only 2 banks that are reporting below the median. Okay, and I mean this panel's not balanced, right? Because what happens is it's not balanced, at least on the dimension of banks, because a bunch of banks have more loans in the sample than others. That was the first thing that threw me when I looked at this, but then I figured out that apparently Bank 14 and Bank 3 have a lot more loans in the sample, because they're the only 2 significantly negative ones. So what I would do is I'd go ahead and check the heck out of their models. I mean, that's like the most obvious thing to do from these results. I mean, you should be telling your colleagues in your Fed, go check out Bank 3 and 14, and then get back to me, okay? And that's kind of a real simple relative performance structure. So, anyways, let me summarize. Information theorists have been looking at incentives and capital requirements. Well, I've played in that area, and the oldest paper I know about is this Giammarino, Lewis, and Sappington paper. I'm sure there's some from before then. And now we have some measurement of the size of some of these effects for a particular black box implicit supervisory mechanism. And that's really, really cool. Somebody who's worked in this theory stuff, this area for a while, to put some numbers on these things is a neat thing. So anyway, so if these results hold up and economic effects are big, then these findings, I attribute as evidence that, the mechanisms that are being used, and I think there's really an implicit mechanism in place, could be improved, at least for wholesale credit. And I gave some suggestions for João and Matt to pass on to their colleagues at New York. So anyways, this is a really cool paper. I like it a lot. Thanks.
Okay, well, thanks to the organizers for inviting me to discuss this very interesting paper. So this paper is really motivated by the big question is how should we regulate the risk-taking of large financial institutions? And clearly one important tool we have are capital requirements. And you already heard about the history, both in the first discussion, the talk. We had Basel I, which basically had a flat charge for broad asset risks like corporate debt. And Basel II and Basel III, it was the idea that you want to more finely distinguish between different asset risks. And one approach was using this internal ratings approach, using information within the banks in order to come up with the right risk rates. And really what this paper does, it considers how this approach is being used in the US. And the very nice key idea in the paper is you want to compare risk assessments across banks for the same firm. So you're going to fix the firm, you're going to look at what different banks are telling you about the same firm. Now, I think this question is obviously hugely important as we think about redesigning financial regulation. I don't have to tell you that. We are at a conference on financial regulation. I think that paper makes great use of a really fantastic data set, and these are important results going forward. So what I want to do in my discussion is just summarize the empirical strategy, give some comments along the way, and then maybe think about some takeaways for capital regulation at the end. So empirical strategy, we asked the research question, do banks have similar assessment of risks, and if not, why? And when I start thinking about this question before knowing anything about this paper, I would say, well, this is a really hard question to answer. Okay, why is it hard to answer? Well, first of all, risk management is very different across different firms. It's not standardized. Second, different banks lend to different firms, and then exposure may be very different across different banks, even looking at the same firm, because there could be different collateral guarantees, credit enhancement. Okay? So really, what the authors should get credit for is they come up with this setup where you really can nicely compare these banks. They address all of these 3 points. First of all, the data is standardized across firms, so that's important. Second, they focus on the lending to the same firm. And then within the set of parameters which are reported, they're going to focus primarily on this probability of default, because that's arguably borrower-specific, not borrower-bank relationship-specific. Okay? So that's a very nice one to compare. They compare others too, but that's the one they focus on. So compare default estimates for the same firm across banks. Now, how do they do that? They use the sample of syndicated loans that are reported at least by 2 banks. They have the data starting 2009, although I think for implementation they only use data starting 2010 up to 2013. So it's actually a relatively short sample. And they focus on the probability of default. And it's sort of this 2-step process. First, they estimate the bank-specific deviation from other banks. Okay? This is this delta PD. The delta threw me off a little bit. I always think about this as sort of in the time series, the first difference. Okay? So this is sort of a difference at a given point in time across banks. They use the median, but they say it's robust to using the mean. They use the actual difference, but they say it's also robust to using percentages. And so this delta PD is bank's I's risk assessment of loan J at time t relative to its peers, relative to other banks which are holding their loan. And then they ask this question, are there systematic differences? So they're really after, like, are these coefficients on banks, are they jointly significant after controlling for time-fixed effects? And as was just discussed, yes, they are. And there's actually quite a range. So if you look at the sort of the least aggressive bank was the most aggressive banks. The estimates in the paper say it's 64 basis points, but if I look at the numbers, I think it's actually a little bit larger. But anyway, it's roughly about 1 cent deviation of this probability of default variable. Okay, so also economically significant. Now I have to point out one minor caveat. They only have 15 banks. Okay, so they use clustering as you should, but clustering theory doesn't really work if you don't have 30, 50 clusters. I will just ignore that problem, but this is sort of one minor caveat, but it looks that this really is as highly significant. And I want to emphasize, I think this is already an important result. Okay? I didn't necessarily expect all banks to report the same numbers. There could be some noise, but I didn't really know that some of them, 14 and number 3 are the ones who consistently on the loans which they report lower numbers for this probability of default. So they really should get credit for this result. And then it's sort of what explains the variation in banks' risk management. Okay? And a natural thing which comes to mind is you're going to suspect there's some regulatory arbitrage. Okay? So banks want to lower the risk assessment to save on regulatory capital. How are you going to look at that? Well, the obvious way is to sort of say, well, let's look whether the low capital banks are more aggressive in their assessment. They are the ones who are going to give you lower probability of default. And so run these regressions where they put in tier 1 capital, and they do it with and without controls, and so it's robust to doing either one. The identifying assumption is here that this regulatory capital only affects the risk ascendant through its incentive to underreport this probability of default. Okay? And if they find the beta being greater than 0, I think they sort of say that suggests regulatory arbitrage. Now, I want to point out, even if they found the beta of equal to 0, you wouldn't necessarily be able to reject that. Okay? That's sort of this issue of reverse causality. If I'm really good at this and I report very well numbers, well, I'm going to have a high tier 1 capital. I'm going to look like a bank who is actually reporting higher probability of default. Okay? So clearly banks, and this is also in regard to the other discussion, they don't do enough of this. If they could go even further, you wouldn't even find that relationship. So this is sort of one way to summarize the result. They do it at the loan level and the bank level, and these estimates are consistent. So here, a point is basically a bank at a given point in time. This is the tier 1 buffer more than a gap. So the ones over here that have a lot of capital buffer, the ones over here less, and the ones who don't have a big buffer relative to the constraint, those are the ones which are reporting the lower PDs. And so, also looking here, it's economically significant. If you look at sort of the ones with the least capital relative to the ones with the most capital, the variation is somewhere around 70 to 100 basis points in the reported probability of default. Now, I think this is great work on regulatory arbitrage. I've done some work on this myself, and usually that's where I would stop. But since I'm the discussant, I have to nitpick a little bit. So I will sort of challenge this, although I'm very much with the office that this is likely to be regulatory arbitrage. So what's the concern? So João had a bunch of concerns. I'm just going to focus on one. What's the possible omitted variable? Well, risk attitude, risk tolerance, perceptions of risks. Okay? Models may be different. The example was brought up that inflation models across Federal Reserves would be different. So some banks may perceive lower risk, and they may also report therefore less risk and operate with higher leverage. If you think about what should determine a bank's capital buffer, I mean, they're all satisfying the capital constraint. The question is how far away, how much of a capital buffer they have. Well, if you think there's not a lot of risk around, I may not have a large capital buffer. And if somebody asks me about what risks there are, I'm going to report lower risks. Okay? So it's not crazy to think that if there's variation in how to perceive risk, well, they're going to lead to them operating with higher leverage. But also they're going to have sort of a more aggressive risk management. They're going to report lower probability of default. Now, the authors are aware of this, and I'm sort of thinking about the other tests they're putting forward in terms of trying to reject this hypothesis. So they have a number of tests, so let me just take you through them. The first test was sort of control for the average portfolio risk. Okay, so this was this regression here. So once you put in this control, what you see is the coefficient on tier 1 capital is still significant. It survives, so that's good. Now, they only look at risks within syndicates. Okay? There are many other ways banks can take on risks. So in some sense, if you think that these are real risk takers, it may not just happen within syndicated loans. That's something which is not controlled for. In some sense, that may show up elsewhere in their risk taking as a bank. So in that sense, this test is not quite perfect. Then they have this other test where they say, well, let's control for risk attitude with bank fixed effects. So this is this column here. So even if you look within the same bank, so you look at the same bank and see how do their reports change as there are changes in regulatory capital, you still find that correlation. Okay? I will come back to that point at the end. Now, I would say if risk attitudes are fixed, that will control for it, but they may change. Okay? So you may, as a CEO, you may think like, well, now the situation is improving. This is during, as they're coming out of the crisis, 2010, 2013. You think things are going better. Well, you may increase leverage and you may report lower probabilities of default. Now, they also look at these interactions with large and riskier loans. They do find the effect is larger for riskier loans, and they argue, well, that is because they're going to save more on risk weights. Okay? Now, you can say, well, there's also more room for disagreement. You're going to spend more time on the large loans. For risky loans, there's more room for having different assessments. It's also the interaction with risk with risk is not quite clear, because actually the biggest bang for your buck, as was shown before in the other discussion, the biggest bang for your buck is underreporting when the probability of default is low. Okay? So it may be harder, but that's going to affect the risk weights the most. And the last one is this exercise, which I like a lot. They sort of try to see to what extent probability of default estimates are predictive of loan spreads. The only issue there is they lose a lot of data. So you can't really do this exercise looking at the same firm anymore. Now you're going to look across firms. So that means if the low capital firms are the risk takers, they're going to go out and do pricing for more opaque firms. That would explain, for example, why their model doesn't have as much explanatory power. They also lose a number of banks, as João has pointed out. Now, overall, sort of these are the tests that come up with. I think, there's no silver bullet, no test is perfect, but personally, jointly, I find them quite convincing. Okay? The one thing I want them to do, and you said in the presentation, I couldn't see in the paper, is, it would be interesting to see how do they differ between the ones who are actually using it for regulatory purposes versus the ones which are still in this trial period. Actually, I would have thought during the trial period, you're not going to shade your risk estimates, although you seem to suggest that they already do that. So anyway, I think showing some of these results, which it seems you have, but are not in the paper, would be helpful. Okay? One thing I want to say, this is sort of coming back to these results on bank fixed effects. I was hugely surprised to find that even looking within the bank during this short period, you still find the results. No matter whether you think it's risk perceptions or whether it's regulatory arbitrage, I would have thought that's something which is fixed for the bank. I mean, regulatory ratios don't move around that lot. And so it sort of made me thinking, this result, where is it coming from? Why did regulatory ratios move around during this period, 2010 to 2013? And that's sort of connecting maybe with what Ned was saying. I mean, I think it would be helpful to think a little bit more about the role of the regulator. Okay? So we know as part of the bank stress tests, which really have been quite forceful during that period, some banks were told, encouraged by regulators to raise more capital. Okay? And at least implicitly what I've heard, some of these banks were also told to improve the risk management. Okay? In fact, some of these banks may actually anticipate this type of exercise. My understanding is the banks don't think this is coming. But when I talk to regulators, we talk about the stress test, my understanding is they understand that banks have an informational advantage. And the one advantage the Fed has is get reports from different banks. Okay? So the stress tests either already or in some sense should really leverage this information. They're going to be able to benchmark across firms. And this is sort of in some sense exactly the exercise you want to do, to benchmark across firms. Okay? So that would mean, if there's a stronger regulatory intervention, that may increase the capital and may also incentivize the banks to provide more conservative risk management. Okay? So the results, at least sort of in the time series, may partly reflect the impact of regulatory enforcement. Okay? Now, this may be just saying that the Fed is in some sense clamping down on this. By telling banks that they have to raise more capital, be more careful, they actually reacted to this. Okay? So that would be one interpretation. The other thing one has to say is, it looks like we always think of this as them being too aggressive. Okay? But if the Fed leans a lot on them, maybe they're going to really report conservative estimates because they think that's what the regulator wants. Okay? That's what he also mentioned in terms of sort of almost like a beauty contest. Okay? So it will be interesting. I don't know whether they're good measures within the Fed, but to what extent these banks actually have been subject to regulatory action, to what extent at least the variation over time would be caused by that. So let me conclude. The main result, which is very robust and very nice, is that low capital banks have less conservative risk management than high capital banks. So they report more aggressive estimates in terms of risk. Arguably, I think that's due to regulatory arbitrage. It suggests this role for benchmarking in bank supervision, but obviously you have to be careful. The moment you use it, you may lose it. There are obviously other things they can do in order to disguise that, so you may be careful that they start reporting the nice things here, but they do it elsewhere. I think we do need to, just in the back of our mind, we need to have to exercise some caution. If capital requirements are costly, because equity is potentially costly, there's some social costs, and banks where in their risk perception, we have to be careful of leaning on them too much. And I think in some sense, the regulator sort of coming down on them has to be careful that they have to be aware of its own role in enforcing this rule and pushing banks to report higher probability of default. Thank you.